How's your crypto portfolio doing?
Poorly, I'm sure, in the past, I don't know, 48 hours, but
Bitcoin went from 50,000 to
I think there was someone snapped a bid. I think Alameda Research snapped a bid at like 42,000.
wow,
They're
a lot of
great at that.
volatility.
It's a lot. It's a
The
lot.
SEC and Coinbase are getting into a fight.
That was my topic. Now you're
Oh, I didn't
upending
know
me.
that. You didn't tell me this was your topic.
No, I
They're
didn't. We'll go
they're
into
like
it.
children. They're fighting.
Let's pull on it. Let's pull on it, man. All right. Let me give you the high level overview. The big thing in here is security. Is this a security or not? So we're talking about regulation. We're talking about who's
I
regulatory
thought this was
domain.
a loan. If it's a loan or not, right, or something like that.
Oh, it is a loan. There's no doubt about that part. If it's whether or not it's a security, it needs to register as a security.
Yeah.
Yes, so Coinbase is upset because other crypto companies are doing Bitcoin pooled loan programs. I think basically hardly any of them, if any, have registered as securities with all the things that's just like a process you have to do. And it requires a bunch of work and a bunch of money and a bunch of hoops to jump through for your users or your buyers of the quote unquote security. By the way, I have no opinion one way or another. Not a lawyer, don't care. The Coinbase CEO yesterday tweeted quite the thread about how angry he is with the SEC because the SEC sent a Wells notice, which is not something I had heard of before, which is apparently some sort of letter that says, don't do the thing. We're going to be mad if you do the thing. So Coinbase cannot launch their Lend program, which would let users on Coinbase lend out Bitcoin and earn yield on that Bitcoin or other coins. I don't know what else. It's fascinating. The fact that crypto has gained so much momentum and become such a snowball that can kind of like, fall down the mountain and run into the side of the regulators and the bankers is, I don't know. If nothing else, it's interesting.
If you talk to the crypto people and they say like, look, if this becomes an issue for us, we're just going to create a decentralized, really decentralized exchanges, like decentralized everything. And so at that point, there's no real person who you're interacting with. It's just algorithms and decentralized, blockchains and blah, blah, blah.
This just took me to like a very sci-fi place where, so like in order to publish that, right, you put the code on GitHub, you get a server and you go and run it on, or maybe you don't get a server. Maybe you just run it on the Ethereum network, right? So you publish your decentralized exchange code. What if GitHub implements KYC AML so you can't upload code without them being able to know who you are so that the SEC can come and find you if you're running an unauthorized decentralized exchange? That's a dystopian thought, but just throwing that out there.
I will say, though, that will run into First Amendment. You can put whatever you want.
Online?
You're not committing any violation by putting code. It's like saying this is how you do it. You're not you're allowed to put instructions as long as it's not instructions to harm anybody.
What's your take, bullish or bearish for Coinbase that the CEO is tweeting that the SEC is, what did he call him, sketchy?
Yeah, no, I think they're at an impasse right now. And I think it will take, they will use all leverage possible to start getting reactions from the SEC. I mean, Coinbase has a history of working with regulators. I don't understand why the SEC took the silent route. I think that the SEC wants the fight because they want clarification from the courts. I think both of them want clarification from the courts. It's just I think the SEC is going to take a route that's more aggressive. They want the fight. They want the courts to get involved. They want the ruling. They want to be able to implement this on a larger scale. And Coinbase just wants to get the business done, so they're gonna avoid the fights. They're gonna placate what the SEC wants, and at the same time, I think I would give Coinbase some sort of leeway here because they've really tried to work with regulators, and if there's one example you want to set is exchanges working with regulators, not the regular fighting with a sole example of of exchange that works with regulators. It's if you want to have a fight with the ones who are like avoiding you, not the ones that are like trying to comply and trying to understand, trying to, navigate this whole regulatory maze.
Yes, totally agree. It strikes me personally, that news strikes me as bearish.
Yeah.
Just because exactly the reason you said, the shining example, you're like your ideal pupil sitting at the front of the class, always has their shirt tucked in, raising the hand, shirt tucked in, hair done perfectly every day, is still getting punished. That's a bad sign for the crypto class as a whole, for onboarding, for the whole thing. But we'll see how it plays out.
My topic was going to be what happens when an IPO where someone. So think about this. I exercised ISO stock. I got a huge chunk of AMT to pay, and suddenly my stock tanks.
The same calendar year?
Same calendar year, right?
So you exercise in January, like we told you to. Thank you very much. And then what?
Yeah. And then let's say you exercise when the fair market value is $100 a share, right? So private market value or whatever, the last fair market value of the company, the 409A valuation, right before they went public was $100. And then the IPO, the stock shoots up to 120, but then subsequently like just tanks to like $80 a share, right? And it's like staying there around like 75, 85, around $80 until the end of the year end. Now, what do you do here? Like, the stock is trading at a discount of the fair market value when you exercised it. You're essentially going to pay taxes. The AMT is essentially a tax on the difference between the fair market value, the exercise price, the strike price, when you exercised it. So it was like $100 the fair market value when you exercised it. And let's say the strike price is $10. So there's $90 per share here of bargain element. And that bargain element is used to calculate the AMT taxes. You have an out here. You have an out, which is to sell the stock on a short-term basis, to not take the long-term, not wait for 1 year for it to become long-term. And this always assumes that, so you're planning to sell the stock 2 years away from the grant, right? So we're here trying to figure out whether we should aim for the long-term qualifying disposition, or if we should actually say, you know what, maybe it's worthwhile to do the disqualifying disposition. Maybe it's better to take the short-term tax rates instead of the long-term ones.
Well explained. What's your question?
Well, how do you calculate that? What factors go into that decision? I can tell you what I'm thinking here. It's like, okay, so what the AMT is. You calculate that in time, but when would it be favorable to sell a short term? I can tell you already, like if your income is zero, right? If your income is zero, it's probably better to sell a short term, right? Because your income, if you sell a short term, the stock now is trading at $80. So 80 minus 10 becomes $70. It's $70 of short term gain. And if you're paying 0% income tax, it's $70 of no income, but most people are in like, let's say 24 or 32% bracket. So they're going to have to pay, let's make it simple. It's 25%. So 25% times that's $70 of gain. That's $17.5 of
AMT
of short-term capital gain
of income. Yeah.
But the AMT usually is either at 26 or 28. So let's assume you're at the short end. You're at the lower end of the AMT right now. So you're going to pay 18.2 if you have the AMT. So that to me is a slam dunk. If your effective or your marginal tax rate is around 25, then it's better to just take the short term hit. But once you fill up the tank of the short term and you're now at the 32% bracket, is 32% of 70 better than 20? Let's say it's 28% this time. 28% of $80.
It's hard to say. There's a lot of trade-offs going on here. So you just got in the weeds. Like what you're saying is that you can find a break-even point for taxes this year where the two are equal to each other, right? You can say, all right, when stock price hits this amount, I think that the AMT and the short-term capital gains effect are the same.
Yeah. So then again, you have a short-term gain. If you sell a short-term, you have $70 of gain, okay? Because it's the price that you essentially sell it, and minus the price that you
paid to exercise.
But on top of that, it becomes compensation income, right? So it's an issue there. The compensation income is much higher in taxes. Or so you pay AMT taxes on the bargain element. And the bargain element was a little bit higher. Instead of being $70, it was $80, right? Because it was $90, I forget. But essentially, it's trying to find an equilibrium where the short-term rates plus the compensation income equals, times a lower gain equals the AMT rate, which might be lower, but the gain is much higher. Right? So you're trying to find that balance. And the best way to do this is using tax software. It's the only way I can tell you. Like at the end of the year, November, the last trading window, you go in, you figure out what the two alternatives are, you model them out, and you get the numbers and you make a decision.
On the other side of this, so there's a seesaw with taxes between AMT and compensation income, right? Where you can try to equalize these by using tax estimation. So that's what you're talking about. The other side of this is your desires for your portfolio and for what you own. And it's what I would call the pace of diversification, right? And these two, in my mind, are always going to be at odds with one another. The faster that you want to diversify, generally, the worse the tax hit you're going to take for the most part. You're talking about a specific situation in which you can a little bit neutralize the tax side and say, all right, you maybe have some free diversification available to you at this price, right? And for that to happen, you need ISO exercise, and then you need stock down post ISO exercise, right?
Yes, exactly.
So is it free diversification at that point?
No, nothing is free.
It's not free.
When you're selling the stock, you're paying taxes, period. And when you're exercising, ISO stock, you may pay taxes or not, but most likely you will be paying either AMT, or if you have a disqualifying disposition, it's compensation income. The question to me is like, how do you equalize those rates, and how do you figure out the break-even point? That's the correct way of thinking about it. It's like, you're gonna, if you do a disqualifying disposition, you're gonna have higher taxes, but you have a lower gain, meaning like you're gonna use the stock price at the moment that you sell it minus the exercise price. But then the AMT, if the stock went down, that means that you probably exercised much higher previously. And so at some point they equalize, and you just have to figure out what is a better way. And like I can tell you already, like the best thing to do is just hire a tax accountant, and you tell them your situation. And if he stares you with like, crazy eyes saying like, I don't understand what you're talking about, find someone else.
Do you have a high need for diversification? Are you extremely concentrated? Are you trying to accomplish other portfolio goals? Do you need the cash? Right? That's a big one. You've already exercised this. Maybe you used a bunch of your cash on hand and your liquidity is low. If you need cash, that's a huge consideration in this.
If the difference is 3%, do you actually go forward and sell a short term? Like if it's 3% in favor of selling a short term, do you go forward and sell it? Well, if you were planning on selling it like on, January the following year, selling it a couple of months early and paying lower taxes, maybe. But some of these stocks of these tech companies, they vary dramatically from day to day. So I don't know.
That's another big one that I wanted to bring up, which is just like the nature of your company from a balance sheet and an operating perspective, right? Is this company new with big quarter to quarter fluctuations, and is it priced for perfection, right? Or is your company relatively middle of the pack, boring operations, what's the historical volatility on this? What's the volatility of your industry sector, right? You can get some base rates around the range of outcomes, right? Are the range of outcomes really huge for your stock or not so much? I would also recommend JP Morgan's The Agony and the Ecstasy, which is about concentrated stock positions. They have really good research on all sorts of sectors and the cost to many people of being concentrated, right? We all know the stories about like Enron, right? It was a terrible place to have concentrated wealth, which a ton of employees had. That's happened in other industries too. Even seemingly boring or sleepy industries have had stocks with really, really bad outcomes where the agony of concentration became clear.
So if the stock is down, 60%, it's one thing. If it's down 10%, it's another thing.
Very much so.
Right? So 60%, what's the historical volatility? Can it recover? I have no idea, but 60% seems like a much bigger mountain to climb than, a 10% fall.
Let's do the math on that real quick if we have time. What percentage do you need to increase? Because we know that downside volatility is more expensive than upside volatility, meaning that if you lose 60% in stock price, you have to gain much more than 60% to get back. So if the stock was 100 and then it goes to 40, from 40 back to 100 is 2.5x?
Yeah, I think so. Yep.
Right? So 250%.
And so at that point, you
or
should
150,
do the calculation.
150.
Those are the moments. So when people tell me like, "Oh, the stock is down like 15%," well, it's it could be, depending on the amount that you're selling, disqualifying this position, you could end up being tax neutral.
It does get really interesting there. So that the kind of magnitude of the downward move against you post ISO exercise is an interesting one. It's a really different conversation at down 10% versus down 50, 60%.
There's a lot to think about this topic. There's so many moving parts. You have to be on top of them. And there's certain dates that really matter. If you want to be able to implement any of this, it has to be, I would say, the last trading day of the year. If you exercised, this year, let's say you exercise in November, right? You'd only have 2 more months to figure this out before you pay AMT tax next year. If you exercise in January, you have until, again, almost at the end of, they become long term in January, but you taxes are calculated in a calendar year, so you have more time to figure this out.
Makes January and December both really interesting months.